Good morning, everyone. Welcome to this update for global stocks and commodities for the 19th of February. And as the title said, the market just continues to basically push higher, mostly all around the world, certainly in America and to a degree in Europe as well. So I've seen the term melt up used to describe the current advance, and that's probably a fairly appropriate one. Um, Markets really have got tremendous momentum at the moment, and that momentum is not showing any signs of easing. Now, of course, that can't continue. I can tell you that with absolute certainty. It can't continue. However, there is nothing on the horizon which suggests that the correction, the inevitable correction, will be anything of any great substance. And in fact, it's been some 7 or 8 months since we had a correction of more than 5%. So it's been an extremely low volatility period. But as we know, that always gets followed by a period of much more substantial volatility. And I'm sure we're going to see several of those during the year. So let's jump on and have a look at what happened last week. And I'll touch on this at the end, but just to mention that it may interest some people that I've been pursuing a strategy in America which is generating better than 5% a month. And it's doing that with a really good degree of reliability and consistency. And if anyone is interested in that, feel free to contact me for more information. I know that different traders and investors are always looking for different alternative ways to make progress in the market, and that's certainly one of them. So let's move on. The American stocks, the S&P, advanced by another 35 points on the week, and clearly we're in a new significant leg upwards. I think a lot of what's driving it in the very short term is that Trump's very theatrical announcement of his massive tax plan is certainly having an impact. It's just added another dimension of positivity and confidence to the outlook that's unfolding in America. And as I've said before, whether you like Trump or not, he certainly is contributing to a great rise in confidence, and confidence breeds more business investment, which creates jobs, which creates more confidence, and it's a cyclical thing. And so that part of the Trump administration is certainly a very substantial positive. Look, a melt-up situation gets, the longer it progresses, the more dangerous it gets, because when a market starts to go a little bit parabolic, then inevitably it's going to come back even harder. But it can go on for some time, and as I've been saying now for many, many years, don't try and second guess the top in the market. The people that tried to second guess the top in the market from about 2011 onwards have seen the S&P go up by more than double, and it was one of the great wealth building opportunities of our lifetime. So you should not involve yourself in trying to pick the top in the market. What you should look for, though, as the market continues to advance, and particularly as it continues to accelerate, is just look for some signs that that we're going to get a pullback. At the moment, they aren't there, but I'm sure they will arise in the not too distant future. Now, inflation in America, and this is, I guess, getting towards the official inflation rate, is now above the magic 2% level, which is what the Fed has said since 2009. That was one of their objectives. Get inflation up to 2% and get the unemployment rate down below 5. They accomplished that 12 months ago. Inflation is now above 2. So the interesting thing is, what will the Fed do in the scenario where we've got Trump likely to add to inflation at an even faster rate? So it's going to be a real battle between the Fed and the Trump administration. Just for the record, the S&P 500 index is up 250% from the 2009 lows, and that borders on the longest cycle in history, both in terms of time and price. It's up there with the 1920s, and of course we know how that ended. And I've also been saying that I think there will be a very, very sharp ending to this particular rally, but is it this year, next year, or 5 years? I do not know, and I don't burn up too much energy thinking about it. The Nasdaq has been leading the way, and it is up 400% from the 2009 lows, and is just basically smashing all records. So technology stocks are certainly leading the way, that's for sure. So let's take a look at the action in America. There's the S&P on a monthly chart to start with, and you can see I've just put a bit of a loose Elliott wave structure on that. I'm not a huge Elliott wave person because you can structure it so many different ways, and it's a bit of a case of the goalposts are shifting. But the basic theory has some validity, and that's major advances occur in 5 cycles, and you can see clearly there. The character of those cycles fits very well with theory and also with human psychology, and you can see that we're in the 5th leg of that major advance from 2009. Now, this 5th leg could continue on for another 12 months. So just because it's run a bit of a way at the moment and is a bit overbought doesn't mean you should start to think that it's going to end soon, because it may not. There's the weekly chart on the S&P, and you can see the acceleration that we're starting to get now. If you look at the relativity of price to the red 200-day moving average line, particularly during a significant advance, you can see that we get about this far. If you can just see the difference in the crosshairs, we tend to get about that far above the 200-day moving average before we get some sort of flattening or some sort of correction. Now, this is significantly higher than where we would normally go. It's greater than where we were here. So therefore, we're in rarefied air. This has started to accelerate to a level which I think is getting a little bit dodgy. You can see it's well above the 50-day moving average. So we may get some sort of pullback in the near term. But I remain firmly of the view that any pullback will be buying opportunity and will not signal the start of some new bear market, because there are just too many things that are lined up that can justify this market advancing further. And I'm pretty confident about that. However, we may get some fairly savage volatility during the year as well. So some of the corrections, may get quite uncomfortable if you're not ready for them. And I'll come back to that at the end, because it's not just where the market goes from the start of the year to the end of the year. It's what happens in between, because most investors are going to react emotionally to these significant fluctuations in price, and it's how you are prepared for that and how you respond to that is so critical. You can easily end up with a market that goes significantly higher across the year, yet you end up losing money because your emotions take over and you just do the wrong things at the wrong time. Moving on now to the Australian market, the Aussie dollar was quite volatile during the week. The US dollar bouncing around a bit, and of course commodity prices influencing the Australian dollar. We finished at 76.7 after being up above 77 for a little bit. And stronger commodity prices are certainly supporting the Australian dollar. General consensus is the American dollar will rise further long term, and if you look at it versus the euro, that's a natural conclusion to make. But I've also been able to read some cases that would justify a lower US dollar. So as far as I'm concerned, anything can happen. I'm not too concerned about which way the currencies go. I'm far more interested in what's happening in the bond market and the stock market. Now, the ASX 200 index was higher by another 85, so certainly very positive. But as I've been saying now for some time, outside the top 10, the banks and the major resource stocks, there just isn't much happening. And really they aren't really advancing consistently, certainly nothing like the American market is. There is some movement and some substantial gains in microcap resource stocks and a few other technology and biotechnology stocks. But look, that is really high risk stuff. They're the sort of stocks that can gain and lose 20, 30, 40% in a single day. So it takes a very, very strong stomach to play that market. And outside of that, there's just really not a lot happening in the Australian market at the moment. So it's pretty hard work. Precious metals, importantly, they're really looking good at a big picture level. The GLD holdings advanced to 841 tonnes, so money continuing to come back into the ETF market, and of course we've got the futures market working its way higher as well, but still closer to its lows and its highs. So that side of it, the money flow side of it, is positive and supporting. The price advance in precious metals and precious metal stocks, I believe, will be potentially very large, but quite volatile. Gold managed to advance $2 on the week, and I would expect a correction soon. Not a correction of any great significance, and certainly pretty mild by the normal standards of the precious metals market. But I wouldn't have all of your money allocated to precious metals at this point in time, because they've had a nice run, and I think we might get a little bit of a pullback. So I would hold some funds in reserve for precious metals, because I think you might get a decent buying opportunity. So let's take a look at. We didn't look at the ASX 200. There it is. There you can see that we are at the same level that we were at in early January. So over 5 weeks, the market has gone down. It's gone back up again, but net hasn't really gone anywhere yet. Let's look at silver. Quite a nice advance. New higher high and higher low. So we are trending again now after what was a very rugged second half to 2016, the perfect storm, as I discussed last week. But that's past us, and precious metals advancing quite nicely. So silver is up above $18. It's getting a little bit overbought in the short term. Gold hasn't advanced quite as much, and is not quite as overbought either. And let's just look at gold on a weekly chart. There we go. And now turning to, let's look at GDX and GDXJ. So there's the precious metal stocks, and they're looking reasonably solid, but haven't really shot the lights out yet. The momentum really hasn't built in the precious metals market, despite some pretty good advances. So GDX is up from 19 to 25. GDXJ, which ran to a high of around 53 at the peak last year, got down to 28 and has now bounced back to 42. So it's rebounded about half the distance. But as I said, at a big picture level, precious metals looking pretty good, and they should be a part of everyone's portfolio, I believe. Copper is back a bit to $2.70, only about 5 cents a pound. The precious metal stocks are looking pretty good, and certainly some of the junior copper miners are showing some good gains as well. Crude oil was down slightly, and it still remains stuck between 52 and 55. And until we get resolution of that, I don't believe energy stocks are going to do a great deal. There's our spot copper chart, so nice little spike in copper, and the fundamental outlook for copper is really strong, apart from the fact that the technicals are now looking a lot better. It looked highly likely that we were in a supply deficit into 2018 and certainly 2019 in copper, but recently we've got strikes in South America, which has shut down production. We've also got some government changes in Indonesia that have prevented the export of copper, and that represents, those couple of things represent around about 10% of global copper production. So when you basically wind in 10% of global copper production, then it's certainly tightening the supply and demand situation, and that's what's been driving copper higher. So to wrap it up, and this is, I think, the most important part of the presentation that I give every week, and that's it's about your strategy and about your process, because without a really clear thought out strategy, you've got absolutely no hope of survival in the market at all. And then the second part is that if you have nutted out a good strategy, that you need to be disciplined about how you apply that. And in my experience over the years, there's an incredibly small minority of traders and investors who actually manage to do this well. So it's the area where you can gain the most leverage if you want to improve your results, is by making sure that you have got a really clear strategy, and a strategy that isn't just going to work when we're in a nice bull market as we're in at the moment, because anyone can make money in this sort of market. It's how your strategy is designed to deal with the inevitable volatility. So you need to think that through. Global equity markets are basically signaling growth, particularly in America, but also to a degree in Europe as well. And the big question is whether that growth is going to be forthcoming. Now, in America, the earnings season has been good enough to justify the 17.5 PE ratio that the American market is working on. So I'm quite comfortable with America. I don't believe it's overvalued, and particularly given how low interest rates are, that gives us a big differential between interest rates and the bond rates and the earnings yield of stocks. And whilever that differential is sitting there somewhere around 3% plus, then stocks aren't overvalued. And that's just a simple law of finance and economics, that money's going to go where it's treated best. And if there's a 3 or 4% differential between the 10-year bond rate and the average earnings yield for S&P 500 stocks, then that gap is big enough to keep people in stocks. If that gap compresses and gets down to, say, 2%, then people are going to look at that and say, well, I'm taking risk in the stock market. 2% over the bond rate is not good enough. I'm going to put my money in bonds. And that's when you reach a top in the market, and you could consider the market overvalued. But we're not at that situation. The differential is big enough to not declare this market as overvalued. So that's the big question, whether the economic growth will come through. And Trump's policies are certainly have the capacity to keep growth in America going, and therefore, if America is growing, they'll drag the rest of the world along with them. So the fundamental backdrop for me, unless Trump gets derailed by his own administration, the fundamental backdrop is very positive and is very supportive of stocks continuing to advance. But look, as I've repeatedly said, this is not going to go up in a straight line. I think it's going to get increasingly volatile. The VIX has been down for too long at this extremely low levels. So what could bring on a correction, even though it would be a buying opportunity? I think the Fed raises rates faster than expected, and that disrupts the bond market, which it would. And there's talk that the Fed may raise rates in March. We'll see about that. Of course, European political instability, the far-right movements in France and Italy, if they gain more traction and there's continued movement for those countries to leave the Eurozone, then that would be massively destabilizing. And of course, the huge debt levels in Europe as well. And then, of course, if Trump's style, his conflict with the American people, his conflict within his own party, if that plunges the US into conflict and a degree of chaos, then obviously that's going to be particularly unhelpful for the stock market as well. And you've got to say there's every chance that that's going to happen, because there's certainly movements to try and shut him down, and he's going to fight and kick with all he's got to avoid that happening. A prudent move, I believe, and this is one of the key things that I think you need to do to deal with volatility, which I expect this year, and that is to periodically cash up. And I've had this discussion with hundreds of people over the years. How do you do that? When do you do it? And how do you do it? Look, it's fairly simple, I believe. When prices are well extended above their mean, be it an index or an individual stock, you look for evidence that steam is going to come out of the stock. So you look for things like intraday reversals, where the stock price opens even higher, sets a new all-time high, and then reverses and closes down significantly on the day. When you see that, it's highly likely that the run in that stock is coming to a short-term end. So sell half, put a bit of money in the bank, and then look to reinvest that money on the dip, which is probably 90 to 95% probable. And that's just a smart, prudent thing to do. So take some partial profit. Another thing that you can do if you understand the options market and you're active in the options market is you can write covered calls, and you can get some terrific premiums by writing covered calls, and that helps offset any temporary downside in the stock. So there are things that you can do. You don't have to just sit there with your entire portfolio and be at the whim of the whim of the market fluctuations, a bit like a bottle floating around in the ocean, just bobbing up and down with whatever wave gets thrown at you. There are things that you can do. And this, of course, helps you to capitalize on the next dip. It just means that the way that you utilize your capital is more efficient. And I can tell you, psychologically, it is just so much easier. That leads to better decision making, and you just get into a cycle where you just tend to do the right things rather than the wrong things. So that's the coverage for this week. Not a lot has been different over the last few weeks. And as I mentioned at the start, if anyone is interested in pursuing an alternative strategy, then certainly I can foreshadow that, give you some information on that if you want to contact me. So please feel free to do so. For anyone else, any non-members, there is my contact details, and I'll be back with you next week. Cheers.